In this video, we're going to be using exercise 9-3 to demonstrate how to calculate the revenue and spending variances. In the problem, we're given both the flexible budget and the actual results on an income statement. Remember, the flexible budget is based upon actual quantity, in this case 7,000 pounds, but using the planning budget's formulas. The actual results are based upon the actual results. So we can see that we have apple-apple to comparison because we're using the same quantity of production. The revenue is actually 28,600. We had planned on it being 29,400. This is an unfavorable variance because the actual results that we had at 7,000 pounds is less than what we would have expected based upon our original calculations at 7,000 pounds. So that difference of 800 is an unfavorable variance. This is something that we need to be concerned about. If we expected to have revenue equal to $4.20 per pound, how come it came in less than that? When you look at the expenses, packing supplies at 7,000 pounds were expected to be 2,800. They actually came in at 29,700. That's an unfavorable variance of 170. Why were our packing supplies more than 40 cents per pound? Oyster bed maintenance came in as a favorable 140. That means our expenses came in under what we expected them to be. Interestingly, this is a fixed amount of 3,600 that was in the budget, but we actually came in at 3,460. I wonder if they gave us a discount. I wonder if we renegotiated our maintenance contract. Any one of those things could be possible and will have to be explained. Why did oyster bed maintenance come in 140 favorable? Someone's going to have to look into that and explain it. Wages and salaries were supposed to come in at 6,040. They actually came in at 6,450. That's a difference of 410. And it's unfavorable because the actual results are higher than flexible. Continue going through the different expenses and you continue to see that our shipping expense is favorable by 270. We had less shipping expense than we expected. Maybe the 75 cents per pound was just an estimate. Maybe UPS had a sale going on. Maybe they gave us a volume discount that we weren't expecting. Anything's possible, but that 270 favorable variance needs to be explained. Utilities were supposed to be fixed at 1260. They actually came in at 1070. That's 190 variance. Let's figure out who renegotiated that contract and let's give them a little bit of a bonus. Let's give them some credit for saving the company that 190 on utilities. Or maybe it's just simply that Commonwealth Edison lowered our rates and that's why we came in at a lower amount. Other, once again, this is going to have to be explained. Why do we have 620 of unfavorable variance? We expected it at 7,000 pounds to be 860, but it actually came in at 1,480. If we really wanted to go one step further, we could do a percentage of sales, a percentage of revenue. We could also calculate the percentage difference. 620 compared to 860 is a pretty large percentage. 410 compared to 6,040. So if you compare the 620 to the 860, it's a pretty large percentage. If you compare the 410 to the 6040, not such a high percentage. So look for the percentage rather than the change to determine how concerned you need to be. If we add up our total expenses and then compare that variance, it's a $600 difference unfavorable. Well, that can be explained by the combination of all of our different variances, some favorable, some unfavorable. But in net, we had $600 unfavorable. Net operating income is unfavorable by $1,400. Some of that is the unfavorable revenue, and the rest of that is the unfavorable expenses. So we're going to have to analyze this information and use it to make changes for the next period.